Good morning. Welcome to the B.F. Anderson Technical Report for April 11th. Just want to make a quick note on the market report that's attached in this email. We have made some changes. One of the changes that we have made is the elimination of the hit ratio, which was the first speedometer. Read a report recently, basically said that it's somewhat of a limited indicator and in many ways can be deceptive, not as good as I originally thought. So I decided to move on and go to something more important, which is understanding the trend of the market. So what we've done is we've gone to an intermediate term trend, which is where we're looking at 5 indexes. We take the percent of those indexes that are in uptrends, and that determines the overall percentage. The middle speedometer is for long term, and that's evaluating our long term 10-20 and where we stand there. And then, of course, we continue to have sentiment. So let's get right into the charts. We have a lot to discuss this morning. This is the NASDAQ. We're continuing to see very good action, very good uptrend. Volume has been a little bit on the low side. However, the moving averages are very constructive. This is an uptrend. This does look like a bull market. Now, on a weekly chart, on a weekly basis, last week we had somewhat better volume. I'm not seeing a lot of real heavy-duty accumulation of stocks right now. I think we're going into earnings season, and that's going to kind of quiet things down a little bit. But we are above the 35-week moving average. You can kind of see where that moving average is starting to kind of turn up a little bit. We're now 1, 2, 3, 4, 5, 6, 7, 8, 9. We're in the 9th week of being above the 35-week moving average, which is very similar to the 200-day moving average. But it looks very constructive. The advanced decline line continues to look positive. We had some good net advancers yesterday. The main thing about the advanced decline line is that we want to notice the trend of the line. You don't really look at it on a day-to-day basis. You just look at the trend. It looks positive. Here we have the high-low index. We're just not getting a lot of new lows. And we are getting new highs. So this is turned up and looks very positive. As you can see, yesterday on the New York Stock Exchange, we had 9 new lows, which, again, we're looking to keep that number under 40 a day. We've had a few periods here where we've seen a pop up, but right back down again. So this particular indicator is very positive. On the long-term indicator, very positive. We've got the moving averages going up. This is the 10-month moving average, 20-month moving average. Now realize these moving averages really are not updated but on a monthly basis, so you're not going to see a lot of change. But the index itself is adjusted on a daily basis. But we're above both moving averages in a strong uptrend. This is an indicator developed by Louise Yamada. I really respect her opinion. Now, the put-call ratio, which is measuring sentiment, is still somewhat neutral. We started to get into greed. Now we've moved back into neutral, so that's a positive. The small caps, which we've been kind of keeping a close eye on because they are somewhat a leader of what you would call greed, or people that are when fear is dominating, the small caps tend to underperform. So we've been a little concerned about them. But on the Russell 2000, a move above 1,600 on the Russell would be very positive. Now, I want to get into the subject of an inverted head and shoulders. Now, this is nothing more than what we would call a V-bottom. Now, back in December, right here, the market had a tremendous sell-off, which actually started in September, October. In fact, the small caps were the first ones to break down. Now, we formed a left shoulder, we've got the inverted head, and then we've got the right shoulder, then we've got a breakout. Now, this pattern has repeated itself many times. In fact, I went back in history, and I want to give you a couple of examples. So in other words, we study history in order to understand the facts of today. Now, what do we know as a fact? We do know that we have an inverted head and shoulders pattern. And since 1950, there have been 16 observable inverted head and shoulders patterns. These patterns tend to be the beginnings of a major bull market. So if we go back to 1994 as an example, you've got your left shoulder, you got your drop that formed the inverted head, you got your right shoulder, and then you really have not even broken out. But we're going to call this point A, which is 1994. So if we move ahead in history and we just look at what happened next, well, I mean, this is what happened next. Here's point A, which is 1995. Now, we were just looking at 94. But look at the tremendous bull market that was launched. From point A to point B, the S&P 500 went up 228%. Now, one other example. Let's go to one other spot in history. Again, we're looking at history just to understand the facts of today. Now, this is 2009. Left shoulder, you made your low, your inverted head, which is the V bottom, and then you had your right shoulder, and so we have point A. So here we are, it's 2009. What happened next? Well, you can see here again that it launched a major uptrend. So from point A to point B, we went up 115%. Now, I really want to take a few more minutes here on the Value Line Geometric Index. The old thinking on Wall Street is the longer the base, the greater the race. So if you think about this logically, what's going on is that you go through these. The worst thing that happens to us is, of course, a bear market, but another bad thing is a sideways market. So when you get into one of these long-term sideways markets, the masses basically lose interest in the stock market. They start going and doing things like annuities and gold and Ponzi schemes and you name it. Because of this lengthy period where the market doesn't go anywhere, people just lose interest in the stock market and they start putting their money in other places. So you can see where this is a potential buildup of fuel. So a particular base in the past that was similar to today was 1966 to 1982. Now that was a 16-year base. And then after 1982, we went up for 18 years. So we had a 16-year base, and then we had an 18-year uptrend. Now just kind of analyze this for a second. You start out here in 1990, just to give us a starting point, and you can see where you get into a consolidation period where the market really just doesn't go anywhere. Then it breaks out, goes to another box, and basically consolidates. Then it breaks out, goes to another box, then it consolidates, breaks out, breaks out, breaks out. Now right here is where it really gets interesting because there really is no consolidation. This is just straight up. Now, people that normally would not invest in the stock market would start coming in here. And that's the problem because what happens is that this ends up forming a bubble. Everybody's running to the market, getting into the market. I can remember back during this period, people were claiming that they were able to day trade for a living. Anyway, the bubble popped, and you can see what happened. Now, where we are today is we have gone for approximately 26 years, not 16 years, but 26 years of a consolidation, of a sideways movement after the 2000 bear market and the 07-08 bear market. Then we got back up again in 15, pulled back, and then in 16 we broke out of this consolidation. Now we have basically are forming the first box on top of this consolidation. So if you go back and look at history, which we looked at a few minutes ago, right here, you're going to see potentially a series of boxes. So what happens is, yeah, we break out, but then we start consolidating again, and no one's interested. It's no big deal. But then all of a sudden we're going to break out, and then we're going to form another box. Oh, maybe I'm starting to get a little bit interested. And then you go to the third box and the fourth box, and then when you finally get that parabolic up move, everybody and their brother wants in. Now let's look at the top five. Now, Chipotle Mexican Grill continues to be in an uptrend. We got the gap up buy signal back here on in February on monster volume, 4.25 million shares on a stock that normally trades 600,000, 700,000 shares. Well, it monster volume, stock gapped up, and has pretty much held that gap up buy signal all along. Looks very positive. Now here's another biotech. The biotechs are starting to come on here. Okay, we got a gap up buy signal here. You can see the gap up on very heavy volume, and just like Chipotle, it has held that uptrend. I would say that looks very positive. Here's another biotechnology stock, company called Invitae Corp. Okay, now you got this big, massive volume, you got the gap up, and the stock has been a little bit choppy in here around the 10-day moving average, and you have kind of seen some pretty heavy selling in here as well. So, it doesn't look as good as other things, but it still looks pretty good. Xilinx, which is our 5G play, semiconductors, massive volume to the upside, big gap up, has held the 10-day, little bit of a potential violation here, but continues to stay in an uptrend. Yesterday we got really good volume, about 4 million shares, which pretty much is higher volume than anything on the sell side for at least the last 2 weeks. So it also gave what we call a pivot buy signal right here. And, so the way you would do this, you go ahead and buy your initial position here, and then as you get your new buy signals, you would add to the stock. Now here's one other stock that we've been in before called Zscaler. This is cybersecurity, gap up. However, we got a violation here of the 10-day on very heavy volume, so we decided to sell our position. A lot of people would wonder, okay, because we got a big up move yesterday of 5.5%. I would say I would continue to watch this situation because you've got this extremely high volume here of 7.5 million shares. I would wait on this one, but it still is a potential buyback if needed. So if you have any questions, let me know. Appreciate you listening.